We're going to go ahead and give all of our participants a minute or so to join. And at around, I want to say it's 5:01 right now. Maybe we'll get started in like 2 or 3 minutes. Alrighty, so it looks like we have a few of our attendees already logged in, so I don't want to keep everyone waiting. What I'm going to do is we're going to get started, and hopefully as people start logging in, they can keep joining our webinar today. They won't miss much. It's probably the introduction. So good evening and welcome everyone. Thank you for joining us on this evening for the 5th and last webinar of a 5-part webinar series on first-time home buyers, your pathway to home ownership. If you're not already familiar with me, I am Suhey Mojica. I am the Senior Coordinator of Business and Assets of the San Pablo EDC, and presenting with me tonight is Lisa Marie Weathers. But before we get started, this webinar is being recorded for others to watch later. A recording will be available on our website at www.sanpabloedc.org. Just keep in mind, everyone, or actually all the participants are muted. We do welcome your questions, so please type them in the Q&A box or in the chat box that's located below your screen. We will answer them at the end of the webinar. Hopefully we have enough time, but yes, just wait. You can type them in as you go, and I will read them at the end of the webinar to answer any questions that anyone has. And again, for all of those who have been joining us for the last 4 webinars, you're probably familiar with San Pablo EDC already, but for those who are not, we are a full service organization for economic growth in Contra Costa County. We are here to help you establish the critical connections you need to succeed in our diverse business ecosystem. San Pablo EDC also provides a broad range of affordable housing opportunities and services to enable low, moderate income residents to gain better housing and financial stability. We also offer various workforce programs, from career training funding to childcare funding for working residents, on-the-job training, and much more. If you would like more information, I welcome you to visit our website at www.sanpabloedc.org, or you can call us at 510-215-3200 for more information. I will have all of that information also towards the end of our presentation if you would like to write it down. And with no further ado, as I mentioned earlier, our presenter today is Lisa Marie Weathers. She has been living her passion for helping first-time home buyers since 2002, first as a loan officer with 2 of the nation's largest mortgage banks, then as a certified nonprofit housing counselor and educator, and currently as a licensed and federally endorsed mortgage broker. If you would like to learn more about Lisa's background and expertise, I invite you to visit her website, or if you have missed any of our prior webinars, I invite you to visit our YouTube channel, where you will find all of our past webinars on demand. So with no further ado, Lisa, the platform is all yours. I will join you later towards the end.
Okay. Hello, everyone. So we're here now to talk about special financing programs. This webinar is really important because the number one obstacle to first-time homeownership has always been down payment and closing costs. So there is a plethora of opportunity or lots of organizations and down payment assistance programs available. We're going to go over some of the bigger ones, but keep in mind that programs change all the time. Some things that aren't available today may be available tomorrow, and vice versa. So let's talk about the main ones that you will find here in California. Let me first take a sip of water, excuse me. So CalHome is a pretty big program that is administered, and it's a program of the state of California. The Department of Housing, the Department of Housing in Sacramento. It's a program that is for low to moderate income home buyers. If you make, and there are income limits for this particular program, so if you make too much money, you will not be able to qualify. The thing with well, I'm going to go into each one more in depth, but we're going to talk about CalHome, we're going to talk about CalHFA, some people call it CalHFA, or California Housing Finance Agency. AC Boost is one that's been around for the last 2 years. That's a program in Alameda County. Neighborhood Lift is a program that came about right after the time of the mortgage crisis. Chenoa, Within Reach are two other programs that I'm going to talk about briefly. And then Suhey will go over Wish and Splash. Next slide. Forgive my voice. So the common denominators in most of these programs is that you have to be a first-time home buyer. So to give you a better understanding of what a first-time home buyer is, because it's not really obvious, it means that you have not owned your primary residence for the last 3 years. So if you had a home back before the mortgage crisis, when a lot of people lost their homes, and then you lost it, you are actually now, after 3 years, you are considered of not owning a home, you are considered a first-time home buyer again. The down payment assistance programs have usually very long-term agreements from 30 years and up, where you have the idea is to help you with money to get your down payment and your closing costs covered by whatever program that you're going to use. And then you usually don't have to make payments on those programs for up to 30 years, and even some of the programs may be forgiven. Deferment is what I just discussed, where you have a loan and it may or may not have interest accruing, but there are no payments due. And that's just to make your payment more affordable so that you can actually get into a home. Some of the programs have very low interest. Some of them have no interest rate attached. Some also have higher interest rate than what you might be able to get if you didn't need assistance. One of the primary requirements is that you have to occupy the property. You have to be an owner occupant, and it has to be a single family residence, which means that there's only one family can live in the home. Not that you can't have family members live with you, but that it's a single unit home. It's not like a duplex or a triplex or, bigger. Like I mentioned, there are income limits. So we'll go over the most common one here in the Bay Area. Also, depending on the program, there may be geographic conditions. There are some that have an equity share, and we'll talk more about what that is. And most of them, when you're a first-time home buyer, we require you to complete home buyer education class. In this market, it's usually online, but you could also do it in person. So shared appreciation or shared equity, that's basically a concept where you will borrow X amount of dollars from whatever entity that you're going to get the money from. And in exchange for them lending you this money, you will pay them back whatever percentage of your loan of your purchase price that you borrowed from them, plus whatever interest, if there is interest. So let's say AC Boost, which is Alameda County Boost, they will give you up to $150,000 to help you purchase a home. And in exchange, they will take their 150,000. They'll look at however much they have loaned to you, express that as a percentage of what your purchase price is, and then you'll have to pay them that back, plus whatever your equity is, whatever value you have accrued in your home once you either pay your loan off or you sell the home. I hope that makes sense. Next slide. So when you pay your down payment assistance loan back is a big question, because the whole point of these programs is to help you borrow less from your main mortgage lender so that your payments will be lower and it'll be more affordable. So, and the repayment really just depends on the program. It really varies. So as it says here, some of the loans don't have any payments due and you'll just pay them back whenever you sell your home or refinance. Some of the loans may have a monthly payment requirement. So if that's the case, when you have a second or third, any additional assistance, you will make your payment on your first mortgage, and then you'll also make a monthly payment on whatever the additional assistance. Some of the loans are due in 5, 30, 45 years, whatever you agree to. And all of the information that you will need to know about whatever assistance that you're getting, it will be disclosed to you up front. So you will know up front before you close on your loan, what you're agreeing to and how you're gonna, when you're supposed to pay back. The thing to be aware of is that most people, when they get a mortgage, they're not going to keep that mortgage for 30 years. Most times you're going to refinance within the first 5 or 10 years. Refinancing is simply getting a new loan to pay off your own old loan, your original loan, and that may be because your interest rate, you can get a lower interest rate, or maybe you need to take some cash out, maybe to pay for college, to pay expenses, whatever it is that you need. Okay, the thing to remember is that when you are getting down payment assistance, there's a whole set of loan documents that you're going to get, because unless it's a grant, each one of the programs that you're going to access has written requirements, and you're going to have usually a deed of trust and a promissory note, and all of the information will be disclosed to you, so you know exactly what is required and what, how you stay compliant. Next slide. So can you refinance? I just discussed what refinancing is. So in most cases, when you're getting down payment assistance, the answer is yes, but very often, and actually I've never seen a down payment assistance program that will allow you to take cash out, meaning, let's say you get a loan to purchase a home, your loan is $400,000. And say your interest rate is 5%, which would be high right now. And say 2 or 3 years down the line, you look at what's going on in the market and you determine that maybe you can get a lower interest rate, maybe 3%. And of course, that'll save you a lot of money. So you want to do that. Very often what you will have to do is approach whoever has loaned you whatever down payment assistance money that you're getting. You'll have to approach them, let them know that you want to refinance, and they will let you know what the requirements are and what the process is. But most times they do not want you to take cash out of the home, because the home is really the collateral for the loans, all of the loans that you're getting. And if you start taking cash out or taking equity out of the property, that reduces your lender's chances of being repaid. So most times it will allow you to refinance if you're getting into a more affordable loan, but they don't want to see you taking cash out. You might be able to, but in most cases it would be a no. You can refinance, but usually no cash out. Another thing to be aware of is that if you wanted to get out of the down payment assistance program in a few years, and it's favorable and makes sense for you to do, all you would have to do is basically, hopefully you have enough equity, you've built up some more value, the value of your home has gone up over the years. You can get a new loan and just take out enough to pay off. You don't actually get any cash, it's all done in escrow. You would basically get a loan that's big enough to pay off all of the debt that you have on the property, and then you'll have one new loan, hopefully with a lower interest rate. Next slide. What happens if you don't follow the terms of the down payment assistance agreement? Usually that is going to be something that is going to be disclosed to you upfront. One of the things that is often a trigger for having to repay whatever down payment assistance that you're getting is that you've ceased to live in the home. So that's one of the requirements of most programs, all of the programs that I know about. You have to remain in the home. If you don't meet the requirements of all of the programs that you have used, because you can layer multiple programs as long as they're compatible, you have a chance that the lender can recall the loan, or they can foreclose on you because you basically defaulted on your loan. So be careful to understand exactly what are the requirements of the program that you've gotten into. And if anything changes, maybe you at some point you might have to move out of the home. Let's say you're moving to another state, or you're being transferred in your job or something like that. Most programs require you to live in the program, but live in the property, but sometimes things happen that you can't control. You definitely let your lender know what's going on, because they may be able to make exceptions or waive some of their requirements. But you always have to remember that if you do not meet the requirements of the loan that you took when you bought your home, you would be technically in default and you could lose your home. Most programs don't want to see that happen. Now here, these numbers change every year. So this is something that you should be aware of, depending on when you actually end up buying your home. You're gonna look at the requirements for all of the programs that you're involved in or that you're planning to use, and your lender is gonna do the same, basically. And they're gonna make sure that you meet the requirements for all of the programs. So right now, the income limit for most down payment assistance programs is 80% AMI. AMI is area median income. And right now, this is probably going to change. It's going to change next year sometime. But right now, here are the numbers. If you are a single person household and you make less than $76,750, then you're going to qualify for most of the down payment assistance programs. Some of the programs will go by the number of people in your household. Some of the programs will go by the people on the loan, and they don't care about how many people live in the household. So it's like a big puzzle. Some pieces fit together, some pieces don't. And it's going to be up to your lender to make sure that they understand who you are, what your needs are, and then layer programs that fit your needs, and make sure that you actually meet the requirements for each of the programs. Next slide. So one of the biggest programs, and probably most popular because it's so well established, is CalHFA or CalHFA. It stands for California Housing Finance Agency. This is one of the programs that does not have the 80% AMI limit. They have actually very high income limits for here in the Bay Area, and I'm going to show you what those are shortly. But the beauty with CalHFA or CalHFA is that you are not necessarily required to put any money into the transaction. It really just depends on where you buy, what money that you're using, and whether or not you're getting a seller contribution. solution. It's possible that you're not required to put any money into the transaction, but you just have to be aware that in this market, because there's not as much money around as there might have been in the past, you're always going to need to put something. I don't think in the last couple of years, I've never had anyone buy a home with less than 5,000 into the transaction. So just keep that in mind. You can certainly get 100% financing, but also keep in mind that you do have closing costs, so that increases the amount of money that you're going to need. With CalHFA, this is a program that is statewide, so it's available everywhere in California. It can be layered with other down payment assistance programs, and they have mortgage insurance, which is, it costs less than if you had used a program that did not use a community program. I hope that makes sense. You also are allowed to buy a manufactured home, which there are not many on the market, but it is possible. They also just recently rolled out a program where you can finance accessory dwelling units. And what that is, they're ADUs, or accessory dwelling units, where once you actually own a home, or if you already own a home and you have space on your property, you can actually build an additional unit. And I think they can be up to 1,200 square feet, because we're trying that, the state is trying to come up with solutions to the affordability crisis. So they will grant you up to $25,000 to help cover the cost of building an accessory dwelling unit on your property that you can then rent out, or anyone can live in. And like all the other programs, or most of the other programs for first-time home buyers, you have to have a home buyer education course. Next slide. With CalHFA, they are a low interest loan. So the way that this works is that a California Housing Finance Agency is not actually lending you the money. What they do is they work with approved lenders. The lenders will actually do the loans for you. They will put the money up to cover whatever loans that you're getting from the state. And at this point right now, they have 3 different loans that you can access. And most of the people that I use are getting all 3 of those loans. Your primary lender is going to handle the process of originating the first, second, and third loans, if you're going to use all of those. And then when your loan closes, the state will purchase that loan from your lender, and then the lender will have money to continue doing the program. So the interest rate is low, but it's not as low as it could be if you have good credit and you did not need down payment assistance, and you can just go to a prime lender and get a really good loan. So it's low interest, but it's not the lowest in the market. So keep that in mind. Right now, according to the income limits for CalHFA, you can make as much as $106,000 and still qualify for the down payment assistance, okay, for their program. Next slide. Here's what I mentioned about the income limits. So for CalHFA in Alameda County, Contra Costa, San Francisco, San Mateo, Santa Clara, and Marin, the maximum that you can make is 248,000. I should back up and say that that number, 106,000 that I just mentioned, that is for you to get the lowest possible interest rate that CalHFA offers. If you're lower than the 106,000, you're considered 80% of the area median income. That makes you low income, which qualifies you for a lower interest rate with the state. Okay, now this is for anybody who is above higher income. You still can qualify for CalHFA, but you will get their standard rate, which, like I said, is not the best in the market, but it's pretty good. So you can see here, Solano County, 196,000, and this doesn't matter. It doesn't matter how many people in your household. This is just talking about the people that are actually going to be on the loan. So if it's a husband and wife borrowing together, they're going to look at the income of just those two people, or maybe it's just one of those people, one of the spouses. They're going to look at the income of that person. As long as you don't exceed these limits, then you qualify. Your income, the maximum of your that you can spend of your income on your housing, plus whatever credit obligations that you have, is 45%, and that's a hard 45.00%. So be very careful to understand that, because when you're getting pre-approved for a loan, sometimes a loan officer might give you the number, a high end of what you're qualified for. Then if interest rates go up, if you go over 45.00, if you're 45.01% of your income plus debt, when they look at your payment, then you won't qualify. So you have to be very aware of that. CalHFA does not have any sale price limits, so it doesn't matter how much the house costs. If it's if it's over 500,000, then they're going to charge you, and it depends on the county that you're in, then you may have to pay an additional fee, but they don't have any actual limits on the price of the home. It just depends on what kind of a loan that you're actually going to end up in, and the county that might limit your price. Okay, next slide. Okay, CalHome, I started out to talk about, this is a state-funded program, and they, again, don't actually lend the money directly to you. They contract with the local nonprofits, public agencies, government agencies to administer the program. And so I used to actually be the I used to handle the CalHome loans for Community Housing Development Corporation in Richmond. And at that time, they had CalHome that would lend up to 38,000. The last time I checked, that program still existed, and it was still 38,000. But like I said, the programs change constantly. Sometimes they run out of money. Sometimes they increase their limits or reduce the limits. So you just have to understand that these are guidelines. They can change at any time. It depends on the agency. It depends on what's going on in the market. And for CalHome, typically there are no payments due. You have a low interest rate that is just simple interest that accrues over the life of the loan that you have. And it's due, you do usually have to pay that back within 30 years. It's due in 30 years. And again, like I said, most people are going to refinance within the first 5 to 7 years and pay off whatever CalHome or any other down payment assistance that they have. This program, you have to be low to moderate income. So go back to the 80% AMI. That's the number for CalHome. And it's the Housing and Community Development in Sacramento. That's the program. That's the organization that funds CalHome. Next slide. Like I said, 80% AMI. There are various agencies that have this money. One government entity that had CalHome money, and I think that they still have a little bit, but the program was kind of suspended for a long period of time, is Vallejo. They have a down payment assistance program that is actually CalHome. So depending on where you're buying, it's always good to talk with your loan officer so they can check and see if there's any local entity that has CalHome money, because like I said, it changes constantly. Same thing as we discussed before, you have to be a first-time home buyer. You have to live in the property. There may or may not be a credit score requirement. It just depends on the agency. And with this particular program, you can borrow up to 105% of your purchase price, which means that you can borrow enough money to pay your down payment, buy the home, pay your down payment, and your closing costs. So it's a good program if you can find it and layer it with other programs if you're low on cash. Next slide. MCC, this is another program, mortgage credit certificate that is just for first-time home buyers, and it's a tax credit. Basically, it's a dollar for dollar credit that you will get to help offset. It's a credit for whatever you're paying in mortgage interest every year. This again is available by county. CalHFA used to have an MCC program, but I'm pretty sure theirs doesn't have money right now. So this is one of those things that you have to check. It's available usually by county. And it's a certificate that you get when you close your loan that you will use every year when you file your taxes to get a tax credit. So it basically makes your home more affordable. It's not always available, and only certain lenders are able to use it. So just ask your lender and your tax preparer when you're ready to buy a home about the MCC program. Next. The other things that you can be aware of, that you should be aware of, are other programs, special financing, the FHA 203K. That is a renovation loan. Basically, it'll give you enough money to purchase a property that is in need of repair, and then it'll also finance the rehabilitation or the repairs, whatever needs to be done. There are lots. The FHA has really wide guidelines. It's a lot of latitude about what you can do. They actually will allow you to buy up to 4 units. As long as you live in one of those units, you can use the rental income from the other 4 units to help you pay your mortgage. They will actually also help you buy a 4 unit that needs repairs. But you have to be aware that even though FHA will allow it, there are not a lot of lenders around who are willing to do it. So you have to ask. 203K is a really good option for, if you have limited, you don't qualify for very much, but there are properties available that are affordable, that you can actually repair for less than it would cost to buy the same property if it didn't need repairs. So just be aware that if you find a fixer-upper, there are loans available. Another one that is the same type of a loan, is just instead of being a federal FHA, it's a conventional home style renovation loan that both of them, one FHA only requires 3.5% down. Conventional home style only requires 3% down. You can also get construction loans. So if you decided you wanted to purchase land and build on that land, or if you already have land that you own, you could actually use a construction loan to build on that property. FHA has something called a one-time closed construction loan, which again allows you to buy the land and also finance the cost to actually build from the ground up. All of these programs will allow 1 to 4 units as long as you live in 1 unit. But again, you have to ask your lender if they will allow any of these programs, if they have access to them. Sometimes it might just be a matter of searching online to find lenders to do these. I kind of included these because I just wanted to let you know that these are possibilities if you're having trouble getting into the market with the prices the way they are right now. I just mentioned CalHFA ADU, which is accessory dwelling units. And then the last one is NACA. NACA is a national program that has really, really low interest rates. And they will allow you to buy up to 4 units as long as you live in one. They have very low interest rates. They have no down payment requirement, no credit requirement, no credit score requirements. But if you're deciding that you're going to do NACA, NACA stands for Neighborhood Assistance Corporation of America, and you can actually Google them to get their information. If you decide to go that route, just be aware that it's a very arduous process. It can take a long time to close. It's difficult, but I mention it because it's a really good option. It's probably the most affordable loan out there. Okay. Next slide. I think I'm done. Yes, I am.
You are done with your slides, Lisa.
Okay.
So thank you so much for all of that great information.
You're
We do
welcome.
want to end with two last down payment assistant programs that we actually administer here at San Pablo EDC. And so I'm going to go ahead and start with the WISH program, which stands for Workforce Initiative Subsidy for Home Ownership. Just like Lisa mentioned in most of the down payment assistant programs, these are programs that the funding comes from one entity, but then is given to like a bank, and then a nonprofit administers that program. So in the WISH program, the Federal Home Loan Bank of San Francisco is the one that usually provides the funding to member banks. And then those member banks work with nonprofits such as like San Pablo EDC, and we administer everything from educating the homeowner to facilitating the application and guiding them through the process. The application then is submitted to the member bank, and the member bank is the one that has the last word in terms of approval for this grant or for this down payment assistance funds. So just to give you a little bit of background as to what WISH is, there is more information on our website. I don't want to give you too much because I don't want to confuse anyone, but this is more of like the idea of how the program works. So they do provide up to $22,000 in down payment and closing assistance. These funds can only be used for down payment and closing. It cannot be used for anything else. Let's say the kitchen needs to be remodeled. You have to use this money as down payment or closing. It can't be used for anything else. The funds are awarded as to a 4-to-1 match. So the maximum that that you would need to contribute in order to get the $22,000, which is the maximum that they can provide, is $5,500 of your own money. Obviously, you can put more of a down payment if you want to, but let's say if you were to put $10,000, you would still only get $22,000 of down payment assistance. No payments are due. 20% is forgiven every year you reside in the property. So after 5 years, 100% of the grant is forgiven. Therefore, after 5 years, you don't owe any of this money. And if you sell in the 6th year or the 10th year, if you resided in that home for the first 5 years, there is no longer a loan that you have to repay. The funds are available on a first come, first served basis with a fully executed purchase contract. And again, when we say subject to availability of funds, it's really important that I mention here when they say first come, first serve, it really means first come, first serve. The funds become available every year in March. And this year, the funds were actually exhausted by the end of August. So if you're really looking to use this program, it's become very popular. So a lot of people are asking about it or they go after it. There's no way of us knowing how much funding is given or is available because even the member banks are not given an amount. The Federal Home Loan Bank will say the funds have been exhausted, and at that point, no one else can obviously have access to the funds. So just keep that in mind if this is a program that you're interested in, that when you do have a property that you have made an offer and you're fully in contract, that you reach out to an organization such as San Pablo EDC. There's probably other nonprofits out there through various cities that administer this program. So I would definitely recommend that you contact them as soon as possible so that they can start helping you with applying for the funds. The WISH funds may only be used towards down payment or reasonable and customary closing costs in association with the purchase of housing, the housing unit to be used as the primary residence of the home buyer, which I already had explained at the beginning. And then if we go to the qualifying criteria, it's basically the same as Lisa mentioned in the previous other programs. Most are based on the 80% of the HUD income limits. In this case, I used Oakland Fremont because we're in Contra Costa, so that's usually what we would use. And I think she mentioned it in that graph where you went by, depending on how many people in your household, that's how much of an income that they would you would qualify for based on what you have in that household. The borrower, again, must be a first-time home buyer. Borrower must occupy the property as a primary residence. You also must complete an 8-hour HUD-approved first-time home buyer education, and you can find a lot of the providers on our website if you're looking. Most of them are being done virtually nowadays just because of the pandemic. So sometimes you can sit on a full Saturday on a webinar, or sometimes now I see that some organizations are that you can do it where it's self-guided, where you can just do certain things and it counts as 8 hours and you get your certificate. That certificate is good for 1 year. So you can use that same certificate if within that year you aren't able to find a home that you want to make an offer for and you don't buy anything, you would have to do it the following year. The debt to housing expense ratio must not exceed 35% of the gross household income. I know that in the past, they have been very strict about this 35%. I have heard that depending on the scenario or the case of that buyer, they may be flexible. There just has to be a very good reason as to why that housing expense is at a little bit over 35%. Which means that they want to make sure that the mortgage that you get from that first lender is affordable and it's not something that's going to take a chunk of the income that you bring home, because you still have other expenses like food and utilities and so on. And so that's what they look at when they're looking at how much can you afford when it comes to paying a monthly payment for a mortgage. They have to be single family detached homes. Condominiums are okay for WISH and townhomes are eligible, but if let's say you were buying a duplex or you were buying a triplex, it would not be qualified. Also, mobile homes and manufactured homes, those are also not eligible for this type of program. So just keep that in mind when you're looking for properties and you want to use this type of down payment assistance. The next one is SPLASH. Which stands for San Pablo Loan Assistance for Sustainable Housing. This is utilizing San Pablo's Housing Successor Agency funding. The mission of this program is to help low-income individuals to become first-time home buyers in the city of San Pablo. So again, just like the other programs, they do go with the HUD jurisdiction over the LMI, which is the low moderate to income. Of the individuals that are going to be served. They can be, it has to be 80% of, LMI as well. And there are no exceptions to this, like Lisa mentioned earlier. It can't be 80, 0.00.3. It will not, they will still not, you would still not qualify. So it has to be 80% or lower. Then the funding, again, like I said, comes from the San Pablo HSA. And the only homes that apply for this type of funding are homes that are within the incorporated city boundaries of San Pablo. If you were looking to buy a house in Fairfield or in Oakland, you wouldn't be able to use this program because this program is solely for individuals or families who are looking to buy in the incorporated city of San Pablo. So with that said, let me go ahead and provide you with some of the more information about SPLASH. As again, this is a deferred payment known as a silent second loan. So no payments will be required until the property is sold or otherwise transferred. That includes refinancing, as Lisa mentioned with the other programs. The loan amount is a shared appreciation loan that she gave the definition at the beginning of the presentation. And it's within a 15-year term or up to 10% of the purchase price of the home, not to exceed $50,000. So let's say, for example, you were buying a home that was $400,000. You would only get 10% of that, which would be $40,000. But then let's say you found a home that was $600,000. 10% of that would be $60,000, but in this case, the most that they can provide you with assistance is $50,000. So that's the most that you will receive. I want to let you guys know though that this we are going to be updating this program. It is going to be a little bit more flexible. So I would recommend that you check with us after January 2022. There will be some changes made to this program. We want to make sure that this program is a little bit more flexible and it's more accessible in terms of how it works. So some of these numbers that I'm giving you right now, as far as how long the term will be and how much assistance you will receive, will be changing in 2022. So I do recommend that if you are interested in buying in the city of San Pablo and you want to utilize this program, that you get in touch with us after January of next year, maybe mid-January 2022, beginning of February. We will have the updated guidelines because some of this stuff will be changing, but I wanted to keep it because the changes haven't been made. So I really don't know what the exact changes will be. But just keep in mind in terms of how it works. The loan interest, again, we said it was the greater shared appreciation or 3% per annum simple interest. That's the way that it would work. And again, you don't have to make any payments until either you sell the home or you refinance the home or you want to prepay it early. There is no prepayment penalty, so the borrower can prepay it at any time. There is no penalty for paying it out early. And again, the term is for 15 years, but like I said, this will be changing. So just keep that in mind. The qualifying criteria, again, with like any other down payment assistance program, you do have to be a first-time home buyer program. So this program is intended for qualified low-income first-time home buyers, only looking to buy within the jurisdictional boundaries of the city of San Pablo. There's no exceptions to that. Borrowers and borrowers' household must meet the income requirements and must agree to continuously occupy the property as their principal residence. The borrower must provide a minimum of 3.5% of the sales price as down payment. And the loan funds may only be used for down payment assistance or non-recurring closing costs. So again, it's only for down payment assistance or closing costs, nothing else. There is priority. I don't know if this is going to be changing with the updated guidelines, but right now they are giving priority to first responders, teachers, and veterans. So just keep that in mind. And the splash also complements, you can, let's say, for example, you found the home, you're getting ready to, make an offer, you go into contract, you can use splash with Wish, you can use splash with HFA, CalHFA, Community Reinvestment Act loans, economic opportunity mortgage, school teacher and employee assistance programs, My Home, and the mortgage credit certificate tax credit program that Lisa mentioned earlier. So you can definitely, you can use multiple programs with this program, as well as with Wish. With Wish, I know that they don't really care as to when they come in your deed as the second or third. So it's a little bit more flexible if you're looking to use other programs that can complement and you can receive more assistance basically. And then the application process, basically there is for potential applicants, there's a review. We definitely ask that you check our website, review with any other programs that Lisa mentioned as well. It's always recommended that you review the program guidelines and that you establish what the requirements are and how to qualify for them. It's very important that you understand what you're signing and what you're getting into in terms of using this program. So we definitely recommend that. You definitely want to pre-qualify with a lender because it is very important that you let your lender know that you intend to use any of this down payment assistance programs, because that's the way that they're going to be able to structure your loan. You don't want to go through the process and then in the middle let your lender know, oh, I want to use this program, because it could take longer. So it's very important that you let them know from the beginning that you are thinking of using a down payment assistance program, so they can work with you and they can see how they can structure your loan with any other programs that are able to complement each other. And then we always say, find a really great real estate agent once you know how much of a home you can afford, and if your lender is working with you towards not only qualifying you for your first mortgage, but also being able to take the opportunity to use any of these programs if you qualify for them. And let's see here. I'm not going to go too much into detail with the application process. If anyone is interested, I do recommend that you get in touch with us here at San Pablo EDC or with any other down payment assistance programs. Please contact Lisa, and she can definitely walk you through more into a more thorough information. We don't want to give you too much because then it gets to be a lot. So all of that information is also on our website. And I guess before we move forward, it's always know what you're getting into. I think this was one of your slides, Lisa. So I don't know if you want to go more into detail because you have more of the experience with the mortgage lending. So I don't know if you want to add anything.
Yeah, the thing that I think is most important is that because there are so many different programs around, and because you're a first-time home buyer, unless you have some kind of a background in lending, you really need to connect yourself with people who understand what you're doing and who have the resources. So you're not required to know all of this information. If you were to read through the mortgage, the deed, and your promissory note, you'd probably be more confused and all the guidelines. So you really should lean on professionals in the industry who understand these down payment assistance programs, because like I said, it's one big puzzle. Some of the pieces fit together, some of the pieces don't, and you really need to know, because a lender, you might call a really reputable big bank, tell them, that you want to do one of these programs that you heard about from San Pablo EDC, and they may, depending on who answers the phone and what day of the week it is, they may not know what you're talking about. So it's really important when you're going to decide on a lender, ask for someone who is well versed on working with first-time home buyers and in layering down payment assistance, because your lender is going to be the one who is going to review everything, who is going to have to digest the information if it's a new program to them, and then explain that to you so that you understand exactly what you're getting into. And if you have questions, you will be able to get the answers. So we can't, it's not reasonable for us to expect you to become a professional in down payment assistance programs. So connect with people who are professionals, who have experience doing this. I just can't say it enough times. No, you need to know the basics, the big picture, and then connect with people who can get into more depth to make sure that you're getting the most bang for your buck and understand what the requirements are. I hope that makes sense.
Okay, so I'm going to go ahead and see if we have any questions as of yet. I think we're getting close to the end of our presentation. It doesn't seem like we have any questions yet, but if you do have any questions, please type them in the Q&A box or in the chat box. In the meantime, while I wait to see if there's any questions, I want to share our contact information so that you can get in touch with either Lisa or myself. If you have anything specific that you prefer not to ask here, that's fine too. Please feel free to either email or call Lisa or myself, and we'll be more than happy to answer any questions that you have. So I believe we don't have any. So I just do want to thank our presenter, Lisa Marie. She's been wonderful. This is, like I said, our 5th webinar in home buying. So thank you so much, Lisa, for all of your time and your expertise.
My pleasure.
I know this like the back of your hand, so it comes really naturally for you. So thank you for sharing your knowledge.
Sorry if it got too involved. I kind of sometimes get into the weeds.
It's great. Thank you so much for sharing your knowledge, because I've learned myself. I come from a banking industry, and also, but there's a lot of the programs that you talked about that I wasn't familiar with, and so there is a lot of programs out there. Like you said, it's just a matter of getting in touch with someone that understands them, so that they're sort of like the person that advocates for you when you're looking for a loan to purchase your first home. So it's really important that you get in touch with someone that really understands how they can help you. with your
Yes.
first home buying purchase.
Right.
So again, thank you to everyone that joined us
Mhm.
today. And if you have missed any of the webinars, as I mentioned before, and you want to start with the first one, we do have them on demand on our YouTube channel, or you can go on our website, and you can definitely visit any of those webinars if something that you might have missed or that you want to go back and look at. We definitely encourage you to do that. And if you do have questions, again, please reach out to us and we'll be more than happy to assist you with any of your questions. So with no further ado, again, thank you, Lisa, and everyone who joined us today. And I hope everyone has a wonderful evening. So
Thank you.
thank you.
Bye.
Bye.